Here's the most uncomfortable number in investing. Since 1926, 96% of US stocks, all of them combined, created no more wealth than a treasury bill. Every gain the market has ever made came from the other 4%. 5 companies account for a tenth of it. So when you pick a stock, you're not really asking whether it's a good company. You're betting you found one of the rare monsters. I made that bet for years, and I made it the disciplined way, with valuation models, financial reports, and the value investing playbook. The index still beat me, not by a little, by a mile. This is the video I wish someone had shown me before my first trade. Almost nobody who tries to beat the market starts with a spreadsheet. It starts with a feeling. Why buy 500 companies when you could just buy the good one? Tesla, Nvidia, the next SpaceX. Buying the average feels like giving up. I believed I was different. I wasn't chasing memes. I had spreadsheets and a framework. I read the financial reports cover to cover, and I followed the advice of value investing gurus. The disciplined, Buffett approved way. And it turns out that the odds are even worse than the 4% number suggests. Over the same century of data, about 4 out of every 7 stocks lost to treasury bills over their entire lifetime. And the median stock actually lost money. The market's whole reputation is carried by a tiny handful of monsters. And everyone else is also trying to pick the monster. So here's a question. If the odds are really that bad, why does everyone seem to be winning? Because you're not seeing everyone. You're seeing a filter. And the filter lives in your group chat. The research has a name for what's happening there: self-enhancing transmission bias. People talk about their trades dramatically more after wins than after losses. And studies show this mathematically favors the spread of the riskiest strategies, because those produce the loudest wins to tell. Your friend told you about the Nvidia call. He didn't mention the 3 that went to 0. Nobody lied to you. You're only hearing the survivors. And because the feed only shows the winners, you do the natural thing. You start buying what's loud. Here's exactly what that costs. Researchers got Robinhood's data and measured it. The most heavily bought stocks each day, the ones everyone piled into, fell an average of 4.7% over the next 20 days. Not stopped going up, went down, reliably enough that short sellers made money betting against whatever retail was buying that morning. By the time the stock is loud enough for you to hear about it, you're not early, you're at the exit. I used to watch people buy those stocks and feel a little superior, because I wasn't buying the hype, I was reading balance sheets. It didn't save me. But hold on, every one of those trades had someone on the other side. Someone sold you that stock at that price. Who? Almost always, it's a professional. Analyst teams, faster data, direct lines to management. When you spot something, you're claiming you saw it before they did. So how good are they? There's 25-year-old scoreboard for this. And last year, 79% of professional fund managers lost to a plain index fund. Stretch the window to 15 years and no category of managers comes out ahead. One man turned that scoreboard into a story. In 2007, Warren Buffett offered a public $1 million charity bet, a plain S&P 500 index fund against any collection of hedge funds over 10 years. One professional had the conviction to take it. Ted Seides, a man whose entire career was picking winning funds, hand-selected 5 funds of funds with over 100 hedge funds underneath. The smartest money on earth curated by a specialist against a fund that makes 0 decisions. 9 years in, Seides conceded. He didn't even wait for the finish. The index fund returned 7.1% a year. The professionals returned 2.2%. The only operation on earth that reliably wins, Renaissance's medallion fund at 39% a year for 30 years, is an army of PhDs with infrastructure you can't rent. And it's been closed to outsiders for decades. The professionals didn't lose because they were stupid. They lost because intelligence, activity, and fees are not the same thing as edge. So understand what you're really attempting here. You're not trying to beat amateurs, you're trying to beat professionals who are losing to a robot. But professionals at least have a scoreboard hanging over their heads. Here's a darker question. If you were losing, would you even know? For most people, the answer is no. Researchers pulled real records from 66,465 brokerage accounts. The most active traders earned 11.4% a year, while the market did 17.9%. Almost none of them knew. They made money in good years, and it felt like winning. But making money and beating the market are 2 different things, and only one of them justifies the effort. Now watch what that gap actually does. Compounded over 30 years on the same $10,000 start, the active trader ends with roughly $250,000. The index ends with $1.4 million. That's not a rounding error. That's a different life created by a difference nobody in that dataset even knew existed. I know that feeling from the inside. For years, I didn't run the comparison either. When I finally did, it stung, and it changed how I invest. The numbers don't lie, most people just never look. I just told you the numbers don't lie, so in fairness, the famous claim that 90% of funds underperform has been criticized for its methodology, and if you were to correct based on the critics' version, the number falls closer to a coin flip. Beating the market is not impossible. We met the machine that does it. But possible is not the same as probable, and most investors never even measure whether they succeeded. Every step you just watched is documented, repeatable, and the default path. It's what happens when you do nothing to stop it. If you're going to pick stocks anyway, and some of you will, and honestly, I still keep a small slice for it, then keep it to an amount you can afford to be wrong with. Treat a stock like a business you're buying, and once a year, run your real number against the index. I spent years learning the complicated way to invest, and the uncomfortable lesson was that the simple way was beating me the whole time. I had confused effort with edge. The real reason I made this video is simpler than all the studies. One day my kids are going to want to buy their first stock, and I'd rather they see the scoreboard now than pay for it with a decade of their own money. Simple doesn't mean ineffective. The people who couldn't sit still beat the people who could.